Tired of losing money in forex trading? What if I told you this one becoming consistently profitable isn't some complex indicators or a hiding strategy, but simply avoiding two common mistakes that all traders make? Today, you are going to learn about the two biggest roadblocks on your path to success. Before we dive in the video, let me ask you a question. Have you ever felt that rush after a winning trade, that feeling of invisibility, only to give all your profit back to the market or more on the very next trade? Or have you ever watched a great setup hesitate only to jump in later and get stopped out? These are the classical signs of the two things we will talk about today. They are not just trading mistakes, they are the emotional trap, and once you learn to recognize them and avoid them, your trading will transform. The difference between the losing trader and the winning trader often isn't about having a magic strategy. It's about psychology and discipline when you shouldn't be in it. So let me break down these two critical mistakes and give you the tools to overcome them. I'm a forex trader, and I've been trading the market for the past 4 years. And what I'm about to tell you, I went through the second year of trading financial market and doing all the two, which leads to losses for accounts, and I spent countless of hours studying the best of the best from the legend the market wizards like Paul to the Jones, the powerful insight of trading psychology like Mark Douglas in his book Trading in the Zone. I read dozens and I immerse myself in. That's the mindset I'm going to help you build today. So without wasting my time, let's dive in the video. The first one is overtrading. Overtrading is like trying to catch every single fish in an ocean. You end up wasting your bait and getting tired, and you probably catch a bunch of trash fish you don't even want. In trading, this manifests as constantly looking for a new trade. Even when your strategy says to wait, it's a sure sign you are trading for the sake of it, not because high probability setup exists. So what actually causes overtrade? It's not a lack of intelligence, it's a lack of discipline, often driven by a powerful emotion. Causes of overtrading: 1. Boredom trading. Boredom trading is a silent killer in the market. From beginner to pro, house to battle. Is that feeling you get when you have been staring at your chart for a very long time, for hours. The market is moving sideways and there's no clear signals. You start to think you have put in much time to be in a trade, so you start looking for patterns where there are none. You might lower your standard, take a risk you wouldn't normally take, or enter a trade just to feel like you are doing something. Think of it like being a shark. Shark doesn't swim around and bite every fish in the ocean. It waits patient for perfect opportunity to strike. It knows that conserving energy and being decisive when the moment is right is key to survive. Most of the time, the shark is just lacking waiting, and that's what successful trader does too. The most profitable traders spend the majority of their time on the sideline, waiting for their ideal setup to appear. And how do you fight boredom? Recognizing that waiting is a skill is a key part of your trading strategy. When the market is quiet, don't force it. Use that time to review your trading journals, analyze past trades, or educate yourself by watching video podcasts and reading books. The market will always be there, and patience is the most valuable asset. Trading is not about constant action, it's about making decisions at the right time. So that is how you fight about the boredom. So the second part that causes overtrading is fear of missing out, aka the FOMO. Fear of missing out is that when the market has already made a massive move and you are seeing it on maybe 5 minutes time frame, 1 hour time frame, depending on your strategy, with huge green or red candle, and your brain scream like jump in. You have to get a piece of this. But let's be real, when you jump into the trade, that is already halfway. You are not getting in at the beginning of the move. You are often getting in right before the exhaustion or the reversal of the market. You are essentially buying at the top, which is already against the rule of the market, which is buying at the low and sell at the high. So that moment you are going against the will of the market. That's where the big banks and institutions traders have already entered. Now they are taking their profit. And who did they sell to? They sell to the people who are afraid of messing up. You became their liquidity and you get stuck holding the bag. So to beat the FOMO, you have to realize that there will always be another trade. Okay, the market is not going anywhere. You don't have to catch every single move. Your goal is not to be right all the time. Your goal is to be profitable over a time. Create a trading rule for yourself. If you miss the initial entry, that's your strategy dictated. If you miss out, period. No exception. This rule might feel painful, but it will save you from painful losses and protect your account. Remember, a trader's success why not by the trade they take, but the one they have discipline to avoid. And the third part of the causes of overtrading is revenge trading. Revenge trading is without a doubt the most dangerous of trading behaviors. You have just taken a loss. Maybe it was a small, maybe it was a big one. It doesn't matter. The ego take a hit. The logical, patient part of your brain gets hijacked by anger and frustration. You feel like burning desire to get your money back and prove to the market and to yourself that you are not a loser. That's where the red mist descends. Your analysis goes out the window. Your risk management rules are ignored. You enter a trade on purely emotional impulse. So how do you prevent this emotional self-destruct? You need a circuit breaker. The most effective rule you can implement mandatory cool down period. Make a firm rule for yourself. After you take a loss, you must walk away from the chart. Take a 30 minutes break. Go get a glass of water. Do some push-ups. Listen to a song. Anything to break the emotions. For a big loss, consider walk away for the rest of the training session or even a day. This simple act of stepping away allows logical brain to regain control. Remember, the market doesn't care about your feeling or your ego. Your only job is to protect your capital. The best revenge isn't winning back your money. The best revenge is sticking to your trading plan. Become consistently profitable over a time. If you're a new trader and you don't know how to extract the trading plan, I'm going to outline the key things that you're supposed to be in the trading plan. Your trading plan contains your trading schedule. Okay, when to trade, either a London session trader or a New York session trader. By defining your hours, you eliminate the temptation to trade during low volume and unpredictable time when nothing is happening. Then the second part in your trading plan also contains the currency pairs you are going to trade or specialize on. Are you focused on major pairs like Euro USD and GBP USD? Okay, sticking to few pairs you know where helps you avoid jumping into unfamiliar markets out of boredom. And the other part is your entry and exit checklist. This is the most crucial part. Every trade must meet a specific set of criteria. For example, there are clear support or resistance level. This checklist is your filter. A trade is either yes or no based on your rules with no room for emotional decisions. And the last part is your risk management rules. How much are you risking per trade? This keeps you from over risking, which we're going to discuss next. This is simple, actionable technique you can use starting today. Create a physical checklist. Before you place a single trade, take out that checklist and go through each of the items. Ask yourself, does this trade meet every single point on my checklist? If the answer is anything less than resounding yes, then you do not trade. It's that simple. Remember the famous quote from Jesse Livermore, one of the greatest traders. The big money is not in buying and selling, but in the waiting. Your goal isn't to be busy. Your goal is to be profitable. Sometimes the most profitable you can do is nothing at all. So why do we do it? It's not because we don't know better. It's because we get seduced by the allure of quick, massive win. It's that gambler's mentality whispering in your ear that is the one going to make you rich. You start seeing dollar sign instead of risk percentage. And here is the code: hard reality. Single bad trade where you risk so much and do more damage to your account than the 100 small disciplined losses. It can hit so devastating that simply can't recover it. That is not just financial loss, it's the psychological one that can make you quit trading for good. And that's exactly what we are going to avoid today. The common battle-tested advice in trading is to never risk more than 1 to 2% of your trading account on a single trade. But when you are in that moment, it's easy to ignore these rules. This is usually caused by two powerful forces. So the first cause of over-risking is the power one, that's the greedy. It's the desire for a Lamborghini, not a comfortable retirement in a few decades. Greedy respects reads nothing in your ear, promise shortcuts in financial freedom. You see a setup that looks pretty good, and instead of sticking to your 1 to 2% rule, you start thinking this trade is so good, I can double my money on this one trade. So you risk 5%, 10%, and even catastrophic 20% of your account. But let's be honest, that is not trading. That's playing lottery with slightly better chance of winning. You are not focused on the process, you are fixated on the outcome. Think of trading like long-running marathon. A greedy trader is like a runner who sprints the first mile at full speed. They feel amazing for a few minutes, passing everyone else, feeling superior. But what happened? They quickly burn out. Their muscles seize up and they collapse on the side of the road, unable to finish the race. The disciplined runner, on the other hand, maintain consistent pace, conserve energy, steady progresses towards the finish line, passing all the sprinters who crash and burn. Really blends you to the most fundamental truth of the market. Every trade has a probability of being wrong. Even the best setup can even fail. In trading, it will lead you to forget basic rules that got you to that point. You abandon your position sizing, you skip setting stop loss, and you believe you can force profit out of the market. You have gone from a disciplined analyst to an arrogant gambler. The antidote to overconfidence isn't to stop celebrating your wins. The antidote is to treat every single trade as if it's your first trade. Celebrate the win, log it in your journal, and then immediately reset your mindset. When you are ready for your next trade, follow your rules, the same discipline you did when you started. That winning streak was the result of a great process. Don't let overconfidence be the reason that great process ends. So, how do you avoid this? First, focus on your capital preservation. Think of your trading account as your most precious asset. Your primary goal isn't to make money, it's to protect the money you have. Profits are consequences of excellent risk management, not a result of a reckless risk taking. And then the second part is always set a stop loss. This is your financial seat belt. Before you even enter a trade, you must know exactly where you will exit if the trade goes against you. This is non-negotiable. Your stop loss automatically closes your trade when it reaches a predetermined loss level. And then the third is to avoid overconfidence. Practice proper position size. This is the secret to 1 to 2 risk percentage rule work. It's not about fixed loss size. You calculate your loss size based on your account size and the distance to your stop loss. For example, if you have $5,000 account and you want to risk 1% of $5,000 account, that's the $50, and your stop loss is 50 pips away. Calculate the loss size that rates only $1 per pip. This mathematical approach removes the emotions and guesswork from your trading. It forces you to be precise and disciplined. Mastering risk management is the single biggest factor that separates professional from the gamblers. So there you have it. The secret consistent profitability isn't having a secret strategy. It's about avoiding these two major pitfalls: overtrading and over-risking. So if you find this video helpful, please give a like and subscribe for more content, and let me know in the comment section which of these mistakes have you struggled with the most.